Right. So we've just had our initial discussion regarding the SA 200, the overall objectives of the auditor, and the discussion regarding the SQC1, right? Quality control, and then the audit procedures, audit evidence, and so. Right. So now we shall come to two set of documents over there. One is your SA 210, agreeing the terms of audit engagement, which talks about the engagement letter, which is to be issued by the auditor to the client. And then coming to your SA 700 series, which is regarding the audit reporting. Right. So once we discuss these two standards over here, rather the 700 series, then we will proceed to our chapter number 8, 9, 10, and 11. Okay. But for that, we need to lay down the base of SA 210 and the 700 series first. Okay. So now SA 210, right, which is regarding the engagement letter, so that you are on a common understanding with the client as to the terms and conditions of the engagement. So it says SA 210 says that CA, you accept an engagement, you be ready to do the audit for any client only if the preconditions for the audit are present, only when the presumptions on which the audit is to be conducted, only if those are present, only then CA you should accept the engagement. Right. So what are these preconditions for an audit? The main precondition, the utmost, most important, number one precondition for an audit is the acceptability of the AFRF. That the AFRF, which is going to be used by the management for the preparation of financial statements, is that acceptable to the auditor? Auditor says your AFRF is only not acceptable, let's not talk about anything else. Forget it. Right? So no further discussion at all. That is precondition, giant precondition, most important precondition. What is that? Acceptability of the AFRF. That management has prepared their financial statements as per the provisions of a contract. Right, some contract they've entered into, and as per the terms and conditions of the contract, the financial statements are being prepared. No problem. But management is telling CA, these financial statements which we have prepared as per the provisions of a contract, for that you express opinion true and fair. Auditor says not acceptable. I cannot give you an opinion saying true and fair for financial statements prepared as per a contract. For those financial statements, I can give you an opinion saying prepared, but I cannot give you an opinion saying true and fair for financial statements which you've prepared as per the provisions of a contract, right? So what does CA say? No, your AFRF is only not acceptable to me, so let's not talk about anything else. But once the AFRF is acceptable, right, so one giant precondition fulfilled, then CA says I have 5 more conditions. What are 5 more conditions? Preparation and presentation of financial statements in accordance with AFRF. Whose responsibility? Management. Your responsibility. Design, implementation, and maintenance of internal controls in the organization. Whose responsibility? Management. Your responsibility. To provide the auditor with all information, additional information which you could require from management TCWG, and unrestricted access to persons within the entity. All this management, it is your responsibility. Right, so in total, how many preconditions for an audit we have? 6. But how we divide that? 1 plus 5. Why? Because if 1 is not accepted, then remaining 5 we don't talk about it. But once the AFRF is acceptable, then we say 5 more conditions. What are the 5 more preconditions? Presentation of financial statements as per AFRF. Management. Your responsibility. Internal controls in the organization. Management. Your responsibility. To give CA all information, additional information, unrestricted access. Management. Your responsibility. Right, so preconditions for an audit. Will you all remember what are the preconditions for an audit? 1 plus 5. Right, 1 is acceptability of AFRF, and once the AFRF is accepted, then 5 other preconditions. Okay, right. Then once these preconditions are okay, it says now auditor, you will issue the engagement letter to the client. And now in this engagement letter, we talk about the principal content means what? Main content. That means most important points to be written in the audit engagement letter. What are the most important points? The objective and scope of the audit. Okay, what is the objective? To obtain reasonable assurance. And what is the scope? Balance sheet, profit and loss for 2025. Example. So that's the objective and scope. Then responsibilities of the auditor. Okay, what are auditor's responsibility? Then what is the responsibility of the management? Then the identification of the AFRF, right? Okay, which is the AFRF which management is going to use for preparation of the financial statements. And last but not the least is the draft format of the audit report, the expected form and content of the report, right? The draft format of the audit report. So point number 3 and 4 in the principal contents of engagement letter are nothing but point number 3 and 4 in the principal contents of the engagement letter are nothing but the preconditions for an audit. Okay, what are the responsibilities of the management and which AFRF you're going to identify which is acceptable to the auditor. So obviously in my engagement letter, should I always write the precondition? Yes. So obviously in principal contents of engagement letter, will there always be the preconditions for an audit? Yes, there will always be a mention of the preconditions for an audit. Right? So objective and scope, responsibilities of auditor, responsibilities of management, identification of AFRF, and the expected form and content of the report. One case study they made, engagement letter has been issued, and in the engagement letter, the objective and scope of audit has been given, responsibilities of auditor has been given, AFRF has been identified, form and content of the report has been mentioned. Do you find any discrepancy in the audit engagement letter? Yes, what is the discrepancy? Management's responsibility has not been given. So that is how indirectly also they check you, that they've given you objective and scope is given, responsibilities of auditor is given, AFRF is identified, form and content. And they say, do you identify, is there any discrepancy in the engagement letter issued? Yes. Why? Because responsibilities of management have not been given. Right? Responsibilities of management have not been given. Right. Then another way in which they make MCQ, that is why you have to put the oil in your eyes and read the question. And what they say, principal contents of audit engagement letter include, and then they say 1, 2, 3, 4 and 5. Right? They say objective and scope of audit. Right? Then responsibilities of the auditor, then responsibility of the management, okay, then identification of and the expected form and content of the audit report and then they make A, B, C, D. D, it has to be all of the above, right? Then A is going to be, say, 1, 2, and 3, right? Then say B is 1, 2, and 5, and then say 2, 3, and 4. Yes, which is the correct option? A, B, C, or D? Arey, tell, why are you saying 1, 2, 3? Say A, B, C, D, no? Don't say E. Anything, huh? What happens to you after you come back from the break? D. Ma'am, we love D. It's always all of the above. Not to break anybody's heart. Arey, it looks same, but it is not the same. Objective and scope of audit. Okay, taken. Responsibilities of auditor. Okay. Responsibility of management's expert. No. Identification of internal control system. No. Identification of AFRF. Expected form and content of the report. So 1, 3 and yes, 1, 2 and 5, right? So 1, 2 and 5. That is B is the option. And that's the golden rule for the exam. The moment you see a question and the moment you think this is the answer, that moment read it again. Because how come? See, I'm not underestimating your talent, your decision making, your intelligence, but you have to cross check. You have to, defend yourself and check it in different ways. Because this, damn thing, you read it on an overall view, it looks same, no? Like objective and scope, responsibilities, identification, expected. We are very fond of reading the first word. So first word, if you read, it looks, yeah, damn, same thing, all of the above. You say, what they are, what they think. Other students won't be able to write answers. See, I so intelligent. Your intelligence is at another level over there. You understand? So that's what, that's the micro reading which I'm talking about. Now it is not there in your syllabus, but old syllabus, there was a chapter on the SEBI LODR, listing obligation and disclosure requirement regulation, wherein it says listed entities within 21 days from the end of each quarter, you had to submit your corporate governance report. You had to submit your corporate governance report to the stock exchanges within 21 days from the end of the quarter. And this corporate governance report should be signed by CEO and CFO, CEO or CFO, CEO and CO, compliance officer, right? And CEO or compliance officer. Right? Or compliance officer. Okay, I know why you failed in the previous attempt. So, okay, right. So, right, CEO or compliance officer, 4 options. Now, logically, if you've left the chapter in option, but now that the question has come in exam and you have to write the answer, generally out of general knowledge, logically, you know everywhere 2 uncles, CEO, CFO. Chief Executive Officer, Chief Financial Officer. And then you say why or? So you will go for and. So you will select this one. Okay, logically. But if you've studied little bit, then you know, okay, no, there is a new uncle there called as compliance officer. So anyways, you delete these 2. So 50-50. Now who is remaining is Chief Executive Officer and Compliance Officer, Chief Executive Officer or Compliance Officer. Now can you say, why to break anybody's heart? Let both of them sign now. What is the problem? Let now both of them sign. So logically you select CEO and compliance officer. Still you are wrong because the correct option is CEO or compliance officer of the company. Right? So you say, ma'am, they are playing with and or. So that's what they are doing. Right? That's the level. Like, if you don't read it only 100% logically, you'll go for CEO, CFO option. But you've studied compliance officer. Then you say, oh, I remember reading, somewhere there was a compliance officer over there. But now between the chief executive officer and compliance officer, whether there was an and or an or, probably it would have been, below materiality. So you would have ignored it. You understand? No, you say it's below materiality. Now, why? You see between 2 points, is there an and? Is there a comma? What? You say, now what? I'd see all this or what? Not possible. So you ignore it. And then what you ignore? See, the moment you see a question and you think this will not come in exam, it has to come in the exam. Okay, right. So chief executive officer or the compliance officer. Okay. So anyways, what we are talking about over here is the preconditions for an audit. How many? 1 plus 5. And then we talked about the principal contents of the engagement letter, right? 5 principal contents of the engagement letter. Okay. We issue 2 copies of this engagement letter to the client. One for them to sign and keep it on their record, and one for them to sign and return it back to the CA so that he comes to know that client has accepted the terms and conditions of engagement. So what I have written in engagement letter to provide the auditor with all information. One of the point I've written. And what client says, CCA, you've written an engagement letter, give all information, but we are telling you that PPE information or inventory information or sales information we will not give. Right? So what am I talking about over here? I'm talking about a very important concept in audit called as the limitation on scope. What was the scope of my audit? To do the audit of the entire financial statements. And now what client is telling me? PPE? No. So are they limiting the scope of my audit? Yes, they are limiting the scope of my audit. 1, if they limit the scope of my audit prior to acceptance of engagement, before I start with the audit, it says don't go. Not to accept such a limited engagement as an audit engagement. Second one, limitation on scope imposed After acceptance of engagement. This is ATF, all-time favorite question of the ICAI. Near and dear to ICAI. What is near and dear to ICAI? Has to be near and dear to us also. Right? So limitation on scope after acceptance of engagement. Last 10 days I have been doing the audit. They gave all information. 11th day they come and say, from tomorrow we can't give you information regarding inventory. So that's a limitation on scope imposed after acceptance of the engagement. Number one, what you do, you will ask the reasons to the management. Right? You will understand the circumstances which necessitated the change. So earlier in my class, the inventory used to be in Ukraine, but now the inventory shifted to Iran. You understand, no? Because we used to say, oh, Ukraine, no, there is war going on over there. So now they are fighting for years together. So now another war has picked up. Right? So now the inventory is over there. So because of that reason, client is telling, see, we are for your life only, we are telling, don't go. You understand, no? So circumstances which necessitated the change. It may give a lower level of assurance to the auditor. Auditor says now reasonable assurance is not possible. One, what you do, you request the management to remove the limitation. However, if management does not remove the limitation, what you do, you perform the alternative audit procedures to obtain the sufficient appropriate audit evidence. And very, very, very important term over here, okay, they are imposing a limitation on scope. Management is limiting the scope of your audit. You have to understand, okay, do they have a RJ? Do they have a reasonable justification to do so? Or is just that it's a big fraud in the debtors, that is why they are not allowing you to check the debtors. So then there is no reasonable justification. But their inventory is in Iraq or Iran, then you say yes, there is a reasonable justification to do so. Right, so you check if there is a reasonable justification to do so. Right, if there is a reasonable justification, alternative procedures and obtain evidence. But if there is no reasonable justification, right, and still if management is imposing a limitation on scope, then CA1, what you can do, issue qualified opinion. If it is material but not pervasive. If it is material and pervasive, one CA you can issue the disclaimer. But client does not very willingly accept the disclaimer. So in that case, CA you may also decide to withdraw from the engagement. Right? So issue qualified or disclaimer, or you may also decide to withdraw. And withdraw is nothing but the resignation of the company auditor. Right? So within 30 days, he has to file the form ADT 3 with the company and with the ROC, and government company also with the C and AG. And the reasons for withdrawal, you also need to communicate it to the management TCWG, highest level of management, that is those charged with governance. Right, so that's a very important case study question in your exams regarding limitation on scope, right, after acceptance of the engagement. Right, limitation on scope imposed after acceptance of the engagement. Right, so that was a very important part of the discussion of SA 210. Now we come to SA 700, which is forming an opinion and reporting on financial statements. Okay, so now CA, when you have to form an opinion on the financial statements, you have to check whether your overall objectives of SA 200 have they been achieved or not. In order to check whether your overall objectives of SA 200 have been achieved or not, it says forming an opinion is an art. Right? So you have AA, RR and TT. Right? What is the art in forming an opinion? What is the art in forming an opinion? Whether all the accounting policies which have been used in the management in the preparation of financial statements, are they adequately disclosed? Then whether these accounting policies, are they consistent with the AFRF? Okay, AFRF allows FIFO or weighted average. If they are using LIFO, then it is not consistent with the AFRF. Next one, what does it say? That all the accounting estimates made by the management in the preparation of financial statements, are they reasonable? Then the information given in the financial statements, is it RRCU, relevant, reliable, comparable and understandable? Next one, the effect of material transactions and events, material transactions and events, is it adequately disclosed? Okay, loss on fire 200 crore. You can't show it under miscellaneous expenses. You have to show it as an exceptional, an extraordinary item. And the terminology used in the preparation of the financial statements, including the title of each financial statement. So title. So even if you have a building of 200 floor, 20 floor or 2 floor, your building has to be called building only. You cannot call it skyscraper or any other name. Why? Because that is the terminology used. Balance sheet has to be called as balance sheet only. You cannot say balancing sheet or something like that. Or sheet of balance of assets and liability. No, the terminology used is it appropriate. Right, so I am appointed as an auditor. I have been given the financial statements to form an opinion. What I have to check in those financial statements to form an opinion, we say it's an art. Whether accounting policies are disclosed, accounting policies are consistent with the AFRF, estimates are reasonable, information is RRCU, material transactions events adequately disclosed, and terminology used is it appropriate. And this, in addition to that, if it's a fair presentation framework, if it's a fair presentation framework, then I will also check the SPC. What is SPC? Structure presentation content. Right? The SPC. What is SPC? The format, the structure, presentation and the content of the financial statements, and also see that the financial statements are prepared in such a manner that they achieve a fair presentation, right? So 2 points of P over here: structure, presentation, content, and the fair presentation. And this is what you need to consider while forming an opinion. In a CA, you need to form an opinion. So you've been given the financial statements of a company. You have to form an opinion. What all will you check in order to form an opinion? AARRTTPP. Right? This is what you need to check while forming an opinion. Okay. Now, then in addition, what does it say? CA, when you have to form an opinion, you will not only consider the quantitative aspects, but you will also consider the qualitative aspects of the entity's accounting practices, including any possible bias in the management judgment, right? Any management judgment, any bias in the management judgment. That means what? What could be the management bias? They are doing the selective correction of misstatements. They are correcting only those misstatements which are increasing their profits and not correcting those which are decreasing their profit. So you tell management, these are the 7 misstatements. They say, out of that, tell me how many will increase profit, how many decrease profit. They say, all that will increase profit, we take entry, decrease profit, we don't take entry. Right? So what are they doing? Selective correction of the misstatements. Whether the selective correction of the misstatements is being done, or any deficiencies in internal control, which individually are not material, but collectively could lead to a significant deficiency in internal control, which has again not been rectified by the management. Right? So this indicates that there is a management bias, that there is a lack of neutrality by the management. Okay, so this year, when say I'm doing audit for 2025 and there is one derivative contract, just one derivative contract company has entered into, and the accounting policy is not right. So quantitatively, is it material? One derivative contract, 5,000 rupees, and accounting policy is not right. Quantitatively, is it material? No, not material, because this year only one derivative contract, but going forward 26, 27, 28 onwards, company is going to enter into tens of thousands of derivative contract. So obviously, when this incorrect accounting policy they apply it in the future, will it lead to a material effect that time? Yes. So this year, is it a qualitative aspect? Yes. So though quantitatively it is not material, qualitatively is it material? Yes. So auditor, while forming an opinion, will you only consider figures, only numbers? Okay, oh, this is more than 10,000 crore, this is more than 4,000 crore. I consider quantitative misstatements, but do I also consider qualitative aspects? Yes. We also need to consider the qualitative aspects, right? So that's an important question for your exam, the qualitative aspects of the entity's accounting practices. Okay. And now we come to the contents of the audit report. Please pay attention, everyone, starting with the title. What should be the title? Independent Auditor's Report. Then you have the addressee. Depends upon the circumstances of the engagement. Generally, it is the members, the shareholders. Then after title, addressee, next paragraph is opinion. In the opinion, first para we have is the introductory para. In the introductory para, we have the 5 points. Right? What are the 5 points we have? One, the summary of significant accounting policies and the other explanatory information. Then the title of each financial statement. Then after that, also the fact that an audit is being conducted, name of the entity, and the date or period covered. Right? So how does our audit report start with? We have audited the accompanying financial statements of ABC Company Limited, which comprise the balance sheet, profit and loss, cash flow for the year ended 31st March 25. Right? So title, addressee, opinion, right? Opinion, you first give the introduction. After the introduction, you express your opinion that whether the financial statements, one, give the information required by the act, and second, whether they give a true and fair view. Right? So true and fair view. So that is opinion paragraph, in which you have introduction and then your opinion. Title, addressee, opinion. Next one is basis for opinion. Basis for opinion paragraph, 4 points. SRES. We conduct our audit in accordance with the standards on auditing. Reference to that section of the audit report where the responsibilities of auditor are given. So you don't write down the responsibilities over here. Here you make a reference to that section of the report where the responsibilities of auditor are given. Then you say we comply with the ethical requirements including independence, and we believe, what do you believe? That the audit evidence we have obtained is sufficient and appropriate to provide a basis for our audit opinion. Title, addressee, opinion, then basis for opinion. Then after that, 2 more paragraphs, going concern, key audit matter, but both of them are visiting paragraphs. They may come, they may not come. Right? So going concern, if any, key audit matter, if any. So whenever there is a material uncertainty for going concern and whenever there is a key audit matter, then these paragraphs may come. Right, then after going concern, key audit matter, next paragraph is the management's responsibility. And a section 134 subsection 5, director's responsibility statement. Selection of accounting policy, making of estimates, going concern, internal control, financial statements, all that is responsibility of the management. Then after management's responsibility, you have the auditor's responsibility is to obtain a reasonable assurance that financial statements are free from material misstatement. Reasonable assurance is a high level of assurance, but it is not a guarantee that a misstatement which exists will always be detected by the auditor. And then there are some additional points in the auditor's responsibility paragraph which can be given in the main report itself, or they can be put as an appendix to the main report, or a link can be provided where these points have been mentioned. What are those additional points in the auditor's responsibility paragraph? That we maintain professional skepticism, we exercise professional judgment, we identify and assess the RMM, we understand the internal controls, we check accounting policies and estimates, we also check for going concern, we also check the structure, presentation and content, and we also communicate with TCWG. Right? So professional skepticism, professional judgment. Then we identify, assess RMM. We check internal control. We check accounting policies and estimates, going concern, structure, presentation, content, and we communicate with TCWG. Right? So title, addressee, opinion, basis for opinion, going concern, key audit matter, management's responsibility, auditor's responsibility, other reporting responsibilities. So what is your main bread and butter? True and fair. And a main bread and butter. But then in addition to that main bread and butter, you have the additional reporting responsibilities under 143.3, 143.11. Right? 143.11 is nothing but your CARO. 143.3 is the 10 points of reporting given. And 143.1, duty as to inquiry. But these points you report only if you have an adverse finding. No adverse finding, no reporting. But 143.3, you always need to report, whether you have a finding or you don't have a finding. CARO, whenever applicable, you need to report. And 143.1, whenever there is an adverse finding, you need to report. And after other reporting responsibilities, then you have the SPD. What is SPD? Signature, place, and the date. Signature along with 3 numbers. What are the 3 numbers? Membership number, firm registration number, and the unique document identification number. Then you have the place of signature, and then you have the date of the auditor's report, right? The date of the auditor's report, right? So these are the basic elements of the auditor's report. What are the basic elements? Everybody, please say it with me. Title, addressee, opinion, basis for opinion, then going concern, key audit matters, if any, management's responsibility, auditor's responsibility, other reporting responsibilities, and then you have the signature, the place, and the date. Right? Basic elements of the auditor's report. What are these? These are the basic elements of the auditor's report, right? So Reliance Industries, if I just quickly come to their audit report over there. Right, Reliance Industries, if we quickly come to their audit report over there, right? How does their report start with? Independent auditor's report, right? Independent auditor's report, right? So that's your title. To the members of Reliance Industries Limited, addressee, right? Then report on standalone, then your opinion. In the opinion, stand. And now what is the stand? We have audited, that is A, the accompanying financial statements of Reliance Industries. So that is name of entity, which comprises the balance sheet, title of each financial statement, 31st March, that is date or period covered, and the summary of the significant accounting policies and other explanatory information. And then the financial statements give the information required by the Act, and also it gives a true and fair view. Right, so title, addressee, opinion, then after opinion we have the basis for opinion. We conduct our audit in accordance with the standards on auditing specified under section 143.10. Then our responsibilities are further described in auditor's responsibility section of our report. So reference to that section of the report where the responsibilities of auditor are given. Then we are independent, we comply with the ethical requirements, and we believe that the audit evidence we've obtained is sufficient and appropriate to provide a basis for our audit opinion, right? Then key audit matters, if any, right? So they have these 4 key audit matters. Then this is 720 other information, which we'll see it later, right? Then after that, responsibilities of the management. Responsibilities of the auditor is to obtain a reasonable assurance. Reasonable assurance is a high level of assurance, but it is not a guarantee. And then the additional points, which can also be given as an appendix or in the main report, is P, professional judgment, professional skepticism. We identify, assess the RMM. We understand the internal control. We also check accounting policies and estimates. We also check whether the accounts have been prepared on the going concern. Then we also check the SPC, structure, presentation, content, and we also communicate the matters to the TCWG, right? We also communicate the matters to the TCWG. Then after that, other matter, if any, then reporting on other legal regulatory requirements. So that is your 143.3, right? The additional points of the reporting. And then you have the signature, right? So 2 firms, that means they have the joint auditors along with 3 numbers: membership, firm registration, and UDIN, and then the place and the date, right? Then the place and the date, right? So that's the basic elements of the auditor's report: title, addressee, opinion, basis for opinion, going concern, key audit matters, if any, management's responsibility, auditor's responsibility, other reporting responsibilities, and signature, place, and date. Okay. Now, other reporting responsibilities. So 143.1 and 143.3. 143.1 is 6 points of inquiry. Do you always inquire about these 6 points? Yes. Do you always inquire? Yes. But do you always report? No. Only if there is an adverse finding you need to report. And here is the reporting, wherein we have the 10 points of the reporting. Right? So what are the 6 points of inquiry? Coincidentally, it is A, B, C, D, E, F. And A stands for advances. Right? Whether loans and advances made by the company, are they properly secured? And the terms and conditions thereof, are they prejudicial? That is detrimental. Loan given 1 crore, security taken 10,000. Period of repayment 100 years. Rate of interest 0.01. You say, my God, is it harmful, detrimental, very hazardous to the interest of the company? Yes. So whether loans and advances, are they properly secured? And the terms and conditions, are they prejudicial, harmful to the interest of the company or its members? Then transactions represented merely by book entries, again whether they are prejudicial to the interest of the company or its members. So ma'am, today morning I had no work. So then sitting, what I did, I revalued a few assets of the company. Then I wrote off a few assets of the company. Then I passed some provision entry. Then I passed some dividend entry. Ma'am, every day I'm passing purchase sales entry. I never get to pass these entry. So today I fulfilled all my wishes. So transactions which are represented merely by book entry, sitting, what to do? Pass journal entry. And a passing journal entry. And SA 240, what does it talk about? Fraud. And one of the type of fraud over there is the FFR, that is your fraudulent financial reporting, right? And second type of fraud is the misappropriation of the assets. Okay. Now, in one of the way, fraudulent financial reporting, means fraudulent accounting, means doing fraud in accounting, means doing accounting fraud. More simple. What is fraudulent financial reporting? It is an accounting fraud. When your out-of-pocket expenses of officers are 2,700, but when you file a claim of 3,500, you're manipulating the accounting records. That means you're doing an accounting fraud. Right? That means it's an accounting fraud. One of the way of doing fraud in accounting is by doing the MOC. What is MOC? Management override of control. What do we say? Design, implementation, and maintenance of internal controls in the organization. Whose responsibility? It is the responsibility of the management. And what management is doing? They are ensuring that all 10,000 employees of the company follow the control, but they themselves are not following the controls in the organization. Doctor is telling everyone, eat healthy food. Why you're eating junk food? Doctor, but eating only junk food. Right? So that is override of the control. Okay? They are themselves not following the controls. And obviously by overriding the controls in the organization, what is the management doing? They are recording the fictitious journal entries. They are recording the bogus journal entry. And that is one of the type of the fraud. And do we make inquiry of that under 143(1)(b)? Yes. Right? We are doing the inquiry of that under 143(1)(b). The transactions represented merely by book entries, are they prejudicial to the interest of the company or its members? Okay. Then point number C for inquiry, where the company is not an investment or a banking company. That means, is this inquiry applicable to investment banking company? No. Whether share securities, debentures, have they been sold at a price less than the price at which they were purchased? That means they have been sold at a loss. That means they were purchased for 100, sold for 80. Again, in the MCQ, what they said, that there is a company, say Geo Limited, which is dealing in shares and securities, which is dealing in shares and securities. And now this company, as an auditor, yes, and they have sold their investments at 80, which they had purchased for 100 rupees. Example. Now, as an auditor, how would you report? So question is that auditor needs to report under 143(1)(a. Auditor needs to report under 143(1)(c). Third one, auditor needs to report under 143(3)(c). And fourth one, no reporting is required. Yes, tell me which is the correct option. No application of what I'm telling you. Which is the correct option? A, B, C or D? Right? The correct option is D. No reporting is required. Why? Because what did we say? Where the company is not an investment or a banking company, where the shares, securities, debentures have been sold at a price less than the price at which they were purchased. Here, what did I tell you in the question? Geo Limited is dealing in shares and security. That means it is an investment company. So no reporting is required. Right? As it is not applicable. Micro reading. Are you getting it? Right? That's the application of the concepts, right? Where questions are coming in the exam. There is another question they ask, that some company, it is involved in promoting the sport of hockey in the country. Right? They are, the company has been formed with the intention of promoting the sport of hockey in the country. And this company is not maintaining the proper records of its PPE, that is of its property, plant and equipment. And as an auditor, you will report this under. Right. Again, what does it say? Report it under clause 1B of the para 3 of the CARO 2020. Second, report it under clause 1A of the para 3 of the CARO 2020. Third one, report it under clause 2A of the para 3 of the CARO 2020, and D is no reporting required. The company is not maintaining proper records of PPE. Right? What is the answer? No reporting is required because it is involved in promoting the sport of hockey in the country. That means it's a Section 8 company, and Section 8 company CARO not applicable. That is why no reporting is required. Right? That is why no reporting is required. Are you understanding that? Okay, you're not understanding. You understand that, right? Those are the tricky questions, right? Like how magician does the trick, no? Like that examiner is playing tricks on you, and each and every trick you're failing with. You understand that? Okay, right. So anyways, let's continue with our inquiry, right? So where the company is not an investment or a banking company. So, if I read it like at an overall level, I say, yeah, 143, 1D, I have to inquire. 1C over there, whether shares, securities, debentures have been sold at a price less than. But there is a condition over there, okay, for not an investment or a banking company. Okay, then 143, 1D, where the loans and advances have been shown as deposits. 143, 1E, whether any personal expenses have been charged to the revenue account, and F is for the fake shares, right? So where shares have been allotted during the year for cash, whether cash is actually received, and if shares have been issued for consideration other than cash, then the position shown in the balance sheet, is it correct, is it regular and not misleading? Shares issued for consideration other than cash, right? So coincidentally, what is it over here? A for advances, B for book entry, C for company not being an investment or a banking company, D for deposits, E for expenses, and F for fake shares, right? That is 143.1, 6 points of inquiry. Then we come to 143.3, the 10 points of reporting. And what are the 10 points over there? Obviously 10 points. So A, B, C, D, E, F, G, H, I, and J. Right. So what are the 10 points over there? The key words for those 10 points can be information, proper, please pay attention everyone, branch, books, right? So company law chapter not applicable, but 143 applicable, right? So information, proper, branch, books, AS, adverse, directors, maintenance, and then IFC and others, right? Directors, maintenance, and then you have the IFC and others, right? So auditor, in addition to your main bread and butter of true and fair, that is your main bread and butter. What is additional you need to do? Make inquiry of these 6 points. Only if you have an adverse finding, you need to report. In addition to that, whether you have an adverse finding or you don't have an adverse finding, you always need to report whether the auditor has sought and obtained all the information and explanation which to the best of his knowledge and belief were necessary for the purpose of audit, whether proper books of account as required by law have been kept by the company, and proper returns for branches not visited by us. Then whether branch auditors report, have they been forwarded to the company auditor. Whether balance sheet, profit and loss account, are they in agreement with the books of account? Whether financial statements comply with the accounting standards? Any observations or comments which have an adverse effect on the functioning of the company? Can any student in the class tell me when will you have to consider the reporting under this one? When we'll have an observation under this one? Observation or comments which have an adverse effect on the functioning of the company. That means whenever there is any concern regarding the going concern of the concern that you are auditing. Whenever there is a concern regarding the going concern of the concern that you are auditing, then that will come under 143(3)(f). Any observations or comments which have an adverse effect on the functioning of the company? So whenever there is a question regarding going concern, what is the package that we have? One, we make a reference to SA 570. Second, we make a reference to AS1 or the Ind AS1, because fundamental accounting assumption, going concern, mentioned in AS1. Third, we make a reference to 143(3)(f). Any observations or comments which have an adverse effect on the functioning of the company? And fourth, we make a reference to clause, you tell me, of CARO 2020. Clause 19. What is clause 19? The material uncertainties about the ability to meet the liabilities, right? Material uncertainty for the ability to meet the liabilities. Right? So whenever a case study regarding going concern comes in your exams, are these the four references which you are expected to make in your case study answer? Yes. Right, so SA 570, going concern, fundamental accounting assumption of going concern, that entity will continue its operations for a foreseeable future, a period not longer than 1 year after the balance sheet date is discussed in AS1. Then, if there is any observations or comments which have an adverse effect on the functioning of the company, that is discussed under 143(3)(f), and then clause 19 of the CARO, whether there is any material uncertainty regarding the ability to meet the liabilities. Clear to everyone? So many such packages we'll be talking about, right, when it comes to the case studies. Okay, right. Then whether any directors of the company are disqualified under section 164(2). Any qualifications, adverse remarks regarding the maintenance of accounts, whether the company has the adequate internal financial controls and also the operating effectiveness of such control, right? So whether company has statutory auditor, you need to report whether company has adequate internal financial controls and also the operating effectiveness of such controls. And what is last one? Such other matters as may be prescribed. Generally what we think, others may, there should be nothing, because it's others, no? Such other matters as may be prescribed. Where are the others given? 143(3)(j). Now under the J, we have A, B, C, D, E. Under E, we have E1, E2, E3, and then we have the F and the G. So you know how reference of company law can come in exam? 143(3)(j), E3. How to read it, even I don't know. But that's what is given. 143(3)(j). In that E, in that 3. Can they ask? They very much ask. You understand that? Okay. So what are you say, ma'am, you're creating on your own. No, it's there in company law. It's there, given in company law over there. Okay. So 143(3)(j), what does it say? Other matters on which auditor you need to report. Whether the company has disclosed the impact of the pending litigation. So pending litigation means what? Contingent liability. Contingent liabilities, have they been disclosed? Then whether company has made a provision for the material foreseeable losses. So obviously material foreseeable losses, concept of prudence, what does it say? Anticipate losses and expenses to be provided for. So whether provision has been made, whether there is any delay in transferring amount to investor education and the protection fund. D has been omitted. It was regarding the specified bank notes of 500 and 1000 at the time of demonetization. Right, so D has been omitted. F, whether dividend paid or declared during the year, whether dividend paid or declared during the year, is it in compliance with section 123 of the Companies Act and 143(3)(j)(g). What does it say? Whether the company's accounting software has an audit trail feature, and this audit trail feature, is it OTP? What is OTP? That it has operated throughout the year, it has not been tampered with, okay, nobody should go and make a change to it, and it has been preserved as per the statutory requirements for record retention. Yes, how many years does a company needs to maintain books of account? 8 years, right? So even this audit trail needs to be maintained for 8 years. Audit working papers, 7 years. But books of account, client, you need to keep for 8 years. So whether company's accounting software has an audit trail feature which has been operated throughout the year, it has not been tampered with, and it has been preserved as per the statutory requirements for the record retention. Okay, and now, right, what is the company doing? It is giving the fund to the, yes, so rather than eating the money of the company like this, how the money of the company is being eaten? Like this. Why? Because the company is giving the money to the intermediary with an understanding, whether recorded in writing or otherwise, that this money which company is giving to intermediary could be a foreign entity also, with an understanding that this money you will use it for the LIGS, loans, investments, guarantees and securities, on behalf of the ultimate beneficiaries of the company. So company says, intermediary, we are giving you 50 crore. And from this 50 crore, you will give loan, you will make investment, you will give guarantee, security on behalf of the ultimate beneficiaries of the company. Right? So whether, other than as disclosed in the notes to account, whether any funds have been advanced by the company to the intermediary with an understanding, whether recorded in writing or otherwise, that this money will be used for the benefit of the ultimate beneficiaries of the company. So that is E1. Auditor, you need to report whether any such funds have been given by the company to the intermediary. And now what happens in E2? The intermediary becomes the funding party. So now what does the funding party do? It gives the money to the company. In E1, I gave the money to the intermediary and said, you use it for my ultimate beneficiary. In E2, the intermediary is now becoming the funding party, and it is giving the money to the company and now telling the company that this money you use it for the ultimate beneficiaries for their loans, investments, guarantees and securities. So what is under auditor need to report under E1? Right, what auditor needs to report under E1? No funds have been advanced, right? No funds have been advanced to the intermediary. In E2, no funds have been received by the company from the funding party, have been received by the company from the funding party. And regarding this, management is going to give you the representation. And now in E3, auditor, what you need to do, based on the audit procedures performed by the auditor, nothing has come to the auditor's attention that the representations made under E1 and E2 above contain any material misstatement. Okay, the representation which management has made under, okay, we have not given any money, we have not received any money. These representations which the management has made, those representations do not contain any material misstatement, is what auditor needs to report under the E3. Right, this question they ask, in case of a banking company, what are the other matters of reporting by statutory auditor? Now, banking company, CARO not applicable, but 143(3), is it applicable? Yes. Is J applicable? Yes. And under the J, these 7 points, are they applicable? Yes. So that is how it's there in company audit chapter, but they ask the question in banking company chapter. Okay, what are the other matters of reporting in case if you are appointed as an auditor of a banking company? So do you need to report on these points? Because Yes Bank, no? That why this E1, E2, E3 has come? Because of Yes Bank. And again, no funds have been advanced, no funds have been received. And that's why they asked it in the question of the banking company itself. You understand, everyone? 143(3), what are the 10 points? information proper, branch books, AS adverse, directors maintenance, IFC others. And under the others, pending litigation, material foreseeable losses, delay in transferring amount to investor education protection fund. D has been omitted. E, no funds advance. E2, no funds received. E3, representation does not contain any material misstatement. E1 and E2 ka representation. F, dividend paid or declared, is it in compliance with section 123? And then G, whether the company's accounting software has an audit trail feature which has been operated throughout the year. It has not. And T, don't say it has been tampered with. You have to write it has not been tampered with, and it has been preserved as per the statutory requirements for the record retention. Is it clear to all of you? Right? E1, E2 and the E3, and that is 143.3. So rather, if I go into a depth of my understanding in the exam, if there is a question regarding contingent liabilities or AS 29 or the Ind AS 37, and AS 29 or the Ind AS 37, which is provision contingent liabilities, and so should I in my answer also make a reference to 143.3J, A and B over there? Yes, if it's pending litigations or material foreseeable losses. So that goes hand in hand with SA 540, because that is auditing accounting estimates, including fair value accounting estimates and related disclosures. Okay. Anyways, what I have discussed with you right now is the basic elements of the audit report. Title, addressee, opinion, basis for opinion. Yes. Then going concern, key audit matters, management's responsibility, auditor's responsibility, other reporting responsibilities, and then you have the signature, place and the date, right? The signature, the place and the date, right? So those are the basic elements. Okay. Now auditor says, in my audit report, I want to write down, okay, audit has been conducted in accordance with the standards on auditing, international standards on auditing, and the standards on auditing of some other jurisdiction, like say some German auditing standards, Hong Kong auditing standards or so. Right? So can the auditor say so? We write no SRES, basis for opinion. We have conducted our audit in accordance with these standards. But now auditor says, I want to write international standards, standards of some other jurisdiction also. Can he write so? Yes, provided there is no conflict between the requirement between the national standard and these other standards. Second, at minimum, each of the element of the audit report mentioned in the national standard is there in that other standards also. And third, you clearly identify the origin of jurisdiction of the other standards on auditing. So from where did you get these other standards which you also say you are following? So clearly identify the origin of the jurisdiction of the other standards on auditing. Then SA 700 says we have no problem. Write down in your report, okay, you have conducted your audit in accordance with SA, ESA and the SA of some other jurisdiction also. Right? And the SA of some other jurisdiction also. Okay. Then supplementary information. Right? Again, a case study asked in the exams. Supplementary information which is similar to other information that we discussed in SA 720. Right? So like it's the audit report, then balance sheet, profit and loss, cash flow statement, statement of changes in equity, notes to account, and immediately after that, say some chart has been given showing how the revenue of company has increased year on year. Right? So this is what? This is supplementary information. Now, what is the risk for the CA? Okay, somebody may think, not that they will, but somebody, because see, audit report is there on the top, and immediately after that, balance sheet, P&L, cash flow notes, and then this chart given. So somebody may think, this is also part of financial statements, this also CA has audited, and this is also covered in auditor's opinion. That is the risk for the CA. So now what does it say? Supplementary information. Again, a case study asked in your exams, ATF, right? So all-time favorite of the ICAI, right? So first thing CA, whenever you see that there is some supplementary information given along with the Financial information, the audit report and financial statements, you have to check, is it an integral part of the financial statements? You say yes, it is an integral part, no problem, cover it in your auditor's opinion, cover it in your audit opinion, your audit report, and cover it in your opinion. But most of the times it is not going to be an integral part of the financial statements. Then now what you check, this SI. What is SI? Supplementary information. Check whether it has been clearly differentiated. Right? So management has given this chart. Tell management, no problem. You continue to give the chart. But just before the chart, write down a prefix over there, unaudited. Then you want to give 20 charts, no problem. You give how much ever information you want, but put the prefix unaudited. Okay, so check whether it is clearly differentiated. If they've already written unaudited, life is sorted. No problem. It is not differentiated. They've not written the word unaudited. What you will do? Ask management to differentiate. Tell them, write no over there, one word, unaudited. If they agree, problem is over. If you told them write unaudited, they wrote unaudited, problem is over. They say no, will not write, we will keep it as it is. Then what auditor says, no problem, I will put it in my audit report in an other information accompanying the financial statements paragraph. And if other information is to be given as per 720, and if not required, then I will give it in SA 706, other matter. Okay, I will write it in my audit report. Okay, along with this financial statement, some other information has been given which is not been covered in our audit opinion. Auditor says, you write, you don't write, no problem, I write in report. Obviously, whenever I finalize my report, before that, my draft report, I have to share it with the management. Management sees this paragraph I have written. They say, no, CA, no putting such paragraph in your report. Then what CA says, okay, bye, I am withdrawing from the engagement. So can you see, entire audit, no problem. But just because after the financial statements, they put one chart, auditor had to take the extreme step even of resigning from the audit. Because these days I am at a great risk. Because somebody might think this is also audited by me and covered in my auditor's opinion. Right? So that is supplementary information SI discussed in the SA 700. Right? Clear everyone? Do you understand two questions? What are the two questions? SA, ISA and the standards of some other jurisdiction, and second is the supplementary information which is accompanying the financial statements. Okay, and now we are going to discuss the three standards over there, SA 705, SA 701 and the SA 706, right? So very important standards. Okay, SA 705. Okay, so now what is your overall objective of SA 200? Overall objective of SA 200 to obtain reasonable assurance that financial statements are free from material misstatement, whether due to fraud or error. And now what you're saying, no, that the financial statements are not free from material misstatement. Not free means there is a material fraud, there is a material error. Now for this material fraud, material error, you have to check the pervasiveness. Material though it is, but is it pervasive? Pervasive means overall. Right? So material but not pervasive, and second is material and pervasive, right? So that's affecting the entire financial statements. And second reason, when auditor needs to modify his opinion is when there is a limitation on scope imposed by the management. And what happens due to a limitation on scope is that the auditor is unable to obtain sufficient appropriate audit evidence. These are the only two reasons on earth why an auditor modifies his opinion. Either there is a material fraud error or there is a limitation on scope. And for these two reasons, auditor, now you have to check the pervasiveness, the overall effect. If I take the combination of 1-1, what is 1-1? Material misstatement, material fraud, material error. Is it material? Yes. Is it pervasive? No. So in that case, auditor, you create a reservation, exception, qualification, qualified opinion. Financial statements of Geo Limited give a true and fair view, except for the effect of, say, inventory, which is overvalued by 20 crore. That's one. Now, 1, 2. What is 1, 2? Material fraud, material error. Is it material? Yes. Is it pervasive? Yes. So now auditor says bad. Adverse opinion. Financial statements of Geo Limited do not give a true and fair view. Not a true and fair. And not a true and fair. Right. Next one. 2-1. What is 2-1? Unable to obtain sufficient appropriate audit evidence. Is it material? Yes. Is it pervasive? No. So again, in this case, you shall issue a qualified opinion. What would you say? True and fair, except for the possible effect of. Why possible? Because we have not checked only. In 1-1, I have checked and I'm saying it is overvalued by 20 crore. So I know the effect. But here, I could not check only. Had I checked, I would have come to know, okay, is there a problem or there is no problem? Now there is a limitation on scope. I couldn't see. In 1-1, I have checked inventory and I'm saying it is overvalued by 20 crore. But in 1-2, I did not check inventory only. So I don't know only whether there is a problem or no. Had I checked, I would have come to know. So except for the possible effect of. Do you appreciate that both of these are qualified opinion, but the difference is of the word effect and possible effect. Okay, and last one is 2-2. What is 2-2? Unable to obtain evidence. Is it material? Yes. Is it pervasive? Yes. Do you give any opinion? No. Now you give a disclaimer of opinion. What do we say? We are not in a position and we do not express an opinion. We do not express an opinion. Did you notice what I write? Qualified opinion. Adverse opinion. Do I write disclaimer opinion? No, I said disclaimer of opinion. My opinion is qualified. My opinion is adverse. But my opinion is not disclaimer. It's a disclaimer of opinion. Okay, we are not in a position and we do not express an opinion on the financial statements. We are giving a disclaimer. And we are just raising up our hands and saying we are not giving any opinion. Right? So that's a disclaimer of opinion. Right? So now let me see if you understand what we have discussed. Right, so is there a material misstatement? Yes. Have you obtained sufficient appropriate evidence and whether it is pervasive or whether it is not pervasive? So is there a material misstatement? Yes. Have you obtained the sufficient appropriate evidence? No. Is it pervasive? No and yes. And here, is there a material misstatement? Yes. Have you obtained the evidence and is it pervasive? Not pervasive. Quickly tell me 1, 2, 3, 4. Which type of modified opinion? You give me the correct answer for the second one, I understand that you have understood. Right? So which type of modified opinion? Right? What is the type of modified opinion? For one, it will be material misstatement. Have you obtained evidence? No. Is it pervasive? No. So qualified. True and fair except for the possible effect of. Okay. Material misstatement. Okay. Have you obtained evidence? No. Is it pervasive? Yes. So you'll have to give the disclaimer of opinion, and obviously rest is balancing figure. And a qualified and adverse opinion. Okay. Now the contents, please pay attention because this is where now the drafting questions are coming in the exam and students are horrible at it. Okay, so now pay attention. The contents of the audit report, which I discussed with you in essay 700, those were for a clean report. Now we have to discuss what changes are to be made to the contents of the audit report in case of qualified, adverse and disclaimer of opinion. Okay, right. So one, we have our original unmodified opinion, then qualified, then adverse and then disclaimer of opinion. Okay, right. Now in all the 4 cases, you understand the 4 cases, everyone? Unmodified, qualified, adverse and disclaimer. In all the 4 cases, do I need to give a title to my report? Independent auditor's report? Yes. Will it be same to same? Yes, in all the 4 cases. Next one, addressee to the members of ABC Company Limited. Same to same. Then after that, next paragraph in my report is now opinion. For unmodified, I will call it as opinion. For qualified, can I call it opinion? No, no. I'll have to say qualified opinion, adverse opinion, or disclaimer of opinion. Then, will I write the introductory paragraph? Stand. You remember introductory paragraph? We have audited. Right? So, will I write? We have audited the accompanying financial statements of ta 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 ta. For qualified also, we have audited the accompanying financial statements. Same. For adverse also, will I write introductory para first line? We have audited. Yes. And for disclaimer, will I write we have audited? They say if you audit, then why you give disclaimer? They say if you do audit, then why you give disclaimer? So what you'll write? We have not audited the accompanying financial statements of ABC company. No, no. What we write? We were engaged to audit the accompanying financial statements of ABC Company Limited. Are you understanding that? We had come with full preparation to do audit, but we couldn't do because of the limitation on scope. Okay, then you express your opinion. What you say? True and fair. Your true and fair except for the effect or the possible effect of the matters given in the basis for qualified opinion para. So that's going to be my next para, right? Then after that, not true and fair because of the matters given in the basis for adverse opinion para, and we are not in a position and we do not express an opinion because of the matters given in the basis for disclaimer of opinion paragraph. Are you all with me till here? You understand what's happening on the screen over here? Right. Title, addressee, opinion. Next comes the basis for opinion paragraph. Next comes after that is the basis for opinion paragraph. So unmodified, I continue to call it as basis for opinion. For qualified, I will now call it as the basis for qualified, basis for adverse, basis for disclaimer of opinion. In basis for opinion paragraph, what are the 4 points? SRES. Wonderful. Right. Now for qualified, adverse and disclaimer, basis for modified opinion paragraph, what is the first thing on earth which I now need to write in this basis for modified opinion paragraph is the matter which give rise to the modification. What happened? Why you give qualified? What happened? Why you're giving adverse and why you're giving a disclaimer of opinion? And also all your tears, okay, what happened? And all that you first have to mention in your basis for modified opinion, because did you notice in my qualified opinion I have made a reference to basis for qualified, basis for adverse, basis for disclaimer. So obviously now when I come to the basis paragraph, what is the first thing I have to write down? The matter which gave rise to the modification. Then after the matter, now I come to SRES, SRES dash. In basis for disclaimer, we only write down the matter. We don't write down the SRES. What is the last S? We believe that the audit evidence we have obtained is sufficient and appropriate to provide a basis for our qualified opinion, to provide a basis for our adverse opinion. And this basis for disclaimer, you only write down the matter. That's it. Basis for disclaimer, you only write down the matter. Right. Then after basis for opinion, what is the next para? Going concern, if any. So all the 4 situation, if any. Right. Then key audit matters. Now, for unmodified opinion, key audit matter may come, may not come. For qualified adverse, key audit matter will always come. Why? Because for the fact that you are issuing qualified, for the fact that you are issuing adverse, that itself is a key audit matter. There might be other key audit matters there, might not be. But for the fact that you issue qualified adverse, wo khud, that itself is a key audit matter. And disclaimer of opinion, there can never be a key audit matter. Are you did not do audit. From where you got key audit? You say, no, we were engaged to audit. We do not express an opinion. So there is no question of having a key audit matter. Wonderful. Then after that, next point. Next point, management's responsibility, same to same. Then auditor's responsibility is to obtain the reasonable assurance, and then the PRIA without the, yes, Y, and the GST. So PRIA GST. Same thing for qualified, same thing for adverse, but disclaimer. Now what do you do? In the disclaimer of opinion paragraph, in the auditor's responsibility paragraph, now you write down the SRES. Because had I written SRES upstairs? No, I had only written the matter which gave rise to the modification. I did not write down the SRES. So now SRES in case of disclaimer, now I write it in the auditor's responsibility paragraph. What do we say? We conduct our audit in accordance with the standards. Make a reference to that section of the report where responsibilities of auditor are given. We are in that section only. Right. We comply with ethical requirements, including independence. Yes. And will you write, we believe that the audit evidence we have obtained is sufficient and appropriate to provide a basis for disclaimer of opinion. Logical, no? We believe that the evidence we have obtained is sufficient and appropriate to give basis for disclaimer. No. Now what you say? Because of the reasons given in the basis for disclaimer of opinion paragraph, we are unable to obtain the sufficient appropriate audit evidence, right? We are unable to obtain. Okay. And then after that, you have the other reporting responsibilities, same to same, right? 143.3. And then the SPD. What is SPD? Signature, place and date, right? Signature, place and date. So one of the MCQ they ask, okay, auditor has to issue an adverse opinion, but he says in adverse opinion I will not mention my firm registration number and membership number because client may not pay the fee to me. So is it that if it's a adverse opinion you should not give your firm registration membership number? No. Whatever be, those three numbers always has to be given. Membership number, firm registration number, and the UDIN. They always have to be given. You understand? Right. So this is how the contents of your audit report undergo a change in case of qualified, adverse, and disclaimer. Now I want all of you to prepare a format of the audit report in case of disclaimer of opinion, starting with independent auditor's report. Start writing. I want all of you to prepare a format of the audit report for a disclaimer of opinion. Right? Start. Right? Start writing. Independent auditor's report to the members of ABC Company Limited. What will be the heading of opinion paragraph? Opinion paragraph. What shall be the heading? Disclaimer of opinion. Start writing. Independent audit report. Only that's the title of ABC Company? No, that comes later. Independent audit report. Next line. To the members of ABC Company Limited. Yes. Next heading. Disclaimer of opinion. We have audited. No idea. You write down. Disclaimer of opinion. That's heading, no? So weaver will start on next line, no? So what basis for opinion? Basis for disclaimer of opinion. Change. So, out of 36 pages of the answer sheet, you'll finish writing in 12 mark pages only with such small handwriting. Huh? Some of you might require 48 pages. Basis for disclaimer of opinion. Arey, we were engaged to audit, then where is your opinion? In disclaimer of opinion, you write introductory paragraph, we were engaged to audit, then because of the significance of the matters described in the BDO, we are not in a position and we do not express an opinion. Your disclaimer of opinion has no paragraph regarding that. Directly basis for disclaimer of opinion. We were engaged to audit. Then you'll have to give the disclaimer, na? Ye to introduction hua. Look at the material misstatement. When you read it, when you listen to it, you think you've understood. Where is the heading, opinion, paragraph heading? Title. Where is title? Independent audit report. Addressee to the members of. No address, nothing. Now write no disclaimer of opinion. We were engaged to audit. Then we do not express an opinion on the accompanying financial statements because of the significance of the matters described in the basis for disclaimer of opinion paragraph. Then why are you writing opinion? Disclaimer of opinion, Nare. You just thank God that your papers are not coming to me for checking. What you've written? Right now. This is the reality check which you guys had to undergo. Basis for disclaimer. What you write in that? Your tiers, no? What are your tiers? Okay, we were unable to verify the inventory. We were unable to check the debtors. You have to make some story. And then write SRES, right? No. Basis for disclaimer. In that you have to write down the matter which gave rise to the modification. So make some matter on your own and write. We were engaged to audit. Okay, now give the disclaimer. Ho gaya. Now we'll fill it later. Now write down. We do not express an opinion on the financial statements because of the significance of the matters given in the BDO. Basis for disclaimer of opinion paragraph. They're waiting. Let her dictate, then we'll write down. I'm not going to dictate. Anyways. Title, addressee, disclaimer of opinion. In that introduction, we were engaged to audit. Then we do not express an opinion because of the matters described in the BDO. Next paragraph heading, basis for disclaimer of opinion paragraph, in which you will write down the matter. Okay, what happened? What all information you did not get? Right, so right, we were unable to get confirmation from debtors. We were unable to attend the inventory count being conducted by management. And you have to give some, that generally will be given in the question, in the case study in the exam. Then basis for disclaimer done. In that you've written the matter. Next one. Going concern, if any. Okay. Key audit matter. Disclaimer of opinion. Key audit matter. Never, never. So no writing key audit matter. Then management's responsibility. It's normally what we write. Hai na? So that's just okay. You just write down management's responsibility. Auditor's responsibility. Will you write Priya GST? No. SES. Write down. We conduct our audit in accordance with the standards. We comply with the ethical requirements. And then right, because of the reasons given in the basis for disclaimer, we were unable to obtain sufficient appropriate audit evidence. There's a question in the question bank. Discuss the contents of the auditor's responsibility paragraph in case of disclaimer of opinion. Normally, what are the contents of auditor's responsibility paragraph? Normally, what are the contents of auditor's responsibility paragraph? Reasonable assurance, Priya GST. But in case of disclaimer, SES. SES. Then other reporting responsibilities 143(3), and then after that you have the signature, the place and the date, right? Signature, place and the date. Okay, right? So even with writing the headings correctly, right, even that's an error which you identify when you actually start doing the writing over there, right? So how will my audit report look like in case of an adverse opinion? Let's try now for an adverse opinion. Independent auditor's report to the members of ABC Company Limited. Adverse opinion, we have, अरे engage किधर रे अभी, adverse no, we have audited the accompanying financial statements, and then because of the matters described in the basis for adverse opinion paragraph, the financial statements of Geo Limited or in whatever company do not give a true and fair view. So that's my adverse opinion. Then after my adverse opinion, I put the basis for adverse opinion, in which I first write down the matters which give rise to the modification. Then I write down the SRES. We believe that the audit evidence we've obtained is sufficient and appropriate to provide a basis for our adverse opinion. Then going concern, if any. Then key audit matter will always come. Then after key audit matter, next is management's responsibility, auditor's responsibility, other reporting responsibilities, and then signature, place and date, right? And then after that you have the signature, the place and the date. Okay, right? So just let's quickly have a look at a few of the drafting questions that they have asked over here, right, for the qualified adverse and the disclaimer. So anyways, we have this key audit matters, and then after that you have this qualified opinion, right? So qualified opinion wherein you say true and fair except for the effect of the matters described. And then after that, right, there is a question. Okay, see here, Yash is the statutory auditor of Lakshmi Vardhan for 22-23, and respect of loans and advances of 55 lakh given to Sarvagya, the company has not furnished any agreement to CA Yash, and in the absence of the same, he was unable to verify the terms of repayment, right? So that's the qualified opinion, right? So first you have to decide which type of the modified opinion, and then after that the qualified opinion, and then the basis for qualified opinion. In the qualified opinion, first what we have to write down is the introduction. We have audited, and then in our opinion and to the best of our information and according to the explanation given to us, except for the effect or the possible effect of the matters described in the basis for qualified opinion section of our report, the financial statements of Lakshmi Vardhan give a true and fair view in conformity with the accounting principles. And then you have the basis for qualified, in which you first write down the matter. Right, the company is unable to furnish the loan agreement with respect to loans and advances. Then adverse opinion, right? So there is a material uncertainty and going concern assumption is inappropriate, right? That the entity doesn't have a foreseeable future, right? It will have to prepare its accounts on the liquidation basis. So auditor should give the adverse opinion. So again, first you have the adverse opinion. So again, in adverse opinion, first you write down the introduction. We have audited, and then in our opinion, because of the omission of the information mentioned in the basis for or adverse opinion section of our report, the accompanying financial statements do not present fairly or do not give a true and fair view, any one of the two. And then the basis for adverse opinion, in which you write down the matter. Okay, the company faced an extraordinary event. It was not able to possible for the company to realize its assets. There is a significant doubt regarding the going concern. And then last one over there is the disclaimer. So auditor was not able to check the debtors and the inventory. So again, in this case, it says CA, you have to give a disclaimer. Disclaimer of opinion. First introduction will be, we were engaged to audit, and then we do not express an opinion on the financial statements of PQR because of the significance of the matters given in the BDO, the basis for disclaimer of opinion section of our report. And then you write down the basis for disclaimer of opinion, in which you write down the matters. We were unable to obtain the balance confirmation for debtors and for the inventory. Right, for the debtors and for the inventory. Right, in our module 2, right, we have a chapter over there on the group audit. Right, and in that module 2, in the chapter on the group audit, there is one classic question which they are asking, where they say there is a non-consolidation of a subsidiary. Right, so there has been a non-consolidation of one of the subsidiary of the company, and where again they are telling you to draft the opinion. Right, so yes, it says ALM Associates has been appointed as an auditor and it acquired 55% shares in SAM Limited, and they found that the company has not prepared CFS because on the date of acquisition, right, the fair value could not be ascertained. Right, so should they have prepared CFS? Yes, but have they consolidated? No. So do their financial statements give a true and fair view? No. So there is a material misstatement due to the non-consolidation of a subsidiary. That is the reason for the modification of the opinion, and that is why you give the adverse opinion, that the consolidated financial statements do not give a true and fair view, and then the basis for adverse opinion section. Right, so another question, again, non-consolidation of a subsidiary. So adverse opinion, in which you first write down the introduction. We have audited. Then you say, because of the matters described in the basis for adverse opinion section, the financial statements do not give a true and fair view. And then the basis for adverse opinion, wherein you write down the matters that give rise to the modification. Right, then again a question on the key audit matter, and then again a question where 90% of the assets where you were not able to get the evidence. So 90% assets, if you can't get the evidence, you have to issue a disclaimer. So disclaimer starting with, we were engaged to audit. Then we do not express an opinion on the accompanying consolidated financial statements because of the significance of the matters described in the basis for disclaimer of opinion section of our report. And then basis for disclaimer, you write down the matters that give rise to the modification or to the disclaimer. Right, so those are the type of application based. Again, in going concern chapter, you'll see a lot of 705 drafting questions being asked over there. Right, so at least one answer, one of qualified, one of adverse, and one of disclaimer is what you need to write down. Yes. Any question? Okay, right, so qualified, adverse, and disclaimer. Okay, so that is one essay 705. Right, so 705, when does the matter come to 705? It is going to affect your audit opinion. And if it is going to affect your audit opinion, you have to put it in the 2x2 matrix. Either there is a material misstatement or there is a limitation on scope, and then you have to check the pervasiveness, material but not pervasive, or material and pervasive, and then qualified, adverse, qualified, disclaimer of opinion. Okay, then now what has happened in the audit? You have identified a matter which is fundamental to the user's understanding, and it is a matter related to the financial statements. Then you can put it in your audit report under the emphasis of matter paragraph. And if it is a matter which is relevant to the user's understanding, and it is a matter relating to the audit or the auditor's responsibility in relation to the audit, then such a matter you can put it in your audit report under the other matter paragraph. Right, so anything related to the financial statements you want to highlight in your audit report, emphasis of matter. Anything related to the audit you want to highlight in your audit report, other matter paragraph. So there is a matter in my hand and I'm confused whether this matter I should put it in emphasis of matter or other matter. What is the deciding factor? Is it relevant to the financial statements? Is it related to the financial statements? Yes, then emphasis of matter. If not, then the other matter. What are the features of emphasis of matter? One, the heading has to be emphasis of matter. Second, you have to give a clear reference to the financial statements where you can find more information regarding that matter. And by mentioning about that matter in my audit report in emphasis of matter, have I modified my opinion for that matter? Like, I've mentioned that there is a contingent liability of 7,000 crore going on against the company. Have I modified my opinion for that contingent liability? No. Had I wanted to modify, I would have put it in 705. But I'm not putting it in 705. But without modifying, I'm drawing attention to a matter which is already there in the financial statements. Then that comes under the emphasis of matter. And other matter, what has got to be the heading? Other matter. Company has 100 branches. Out of that, 70 branches were audited by the branch auditor. This I want to write in audit report. Where to write? Other matter. That the report is only for a specific set of users. Where to write? Other matter. Right? So anything relevant to the audit, you write it in the other matter paragraph. Okay. And then, yes, you come across a matter in the audit which has been a matter of the most significance in the audit of the financial statements of the current period. Then that matter, you put it in your audit report as a key audit matter. So when you write a matter in your audit report as a key audit matter, you have to write down two things. One, why it was a key audit matter, why you're saying that this is a matter of most significance. And second, now that you're telling it is a key audit matter, how you did the audit, what are the audit procedures you performed to check that matter. Right? So what were the audit procedures performed by the auditor for that matter? Right? So why and how? Right? That you need to write for the key audit matter paragraph in the audit report. Right? So like again, you see in case of Reliance Industries, right? They have these few key audit matters in their report. Right? And for each of the like litigation, estimation of oil and gas reserves. So first on the left hand side, they've explained why. Why are they saying that this is a key audit matter? And they say now that we are saying that this has been a danger area in the audit, how have we addressed? So what are the audit procedure? So nowadays in an audit report, you get to read vouching verification. Okay, we performed the walkthrough, we check the objectivity and competence of the company's internal specialists, we perform substantive testing, we check the disclosures. Right? So it is what the audit procedures being performed by that auditor for the matter which he says is a key audit matter. Okay, right. Quickly give me an answer. Okay, can one same matter come in the audit report under key audit matter as well as emphasis of matter? Can a matter in my audit report, I can say, yes, this is a key audit matter also and it is an emphasis of matter also? Can it so happen? Yes. Can a matter come in any one? Yes. Can it come in both? Yes. Because if I consider it to be a matter of most significance, then I put it under key audit matter. If it is a matter which is fundamental to the user's understanding, then emphasis of matter. When I write it in key audit matter, what do I write down? Why it is a key audit matter and how it is addressed, audit procedure. When I write it in emphasis of matter, I write the heading emphasis of matter, I give a clear reference to note number 19 or so, and then I say my opinion is not modified. Right? So say there is a contingent liability of 7,000 crore. Example. Right? So will I want to say, oh my God, this contingent liability was a key audit matter and this is how we addressed it in the audit? Yes. And can I say, oh, this is fundamental to users' understanding, so I'm making a reference to note number 19, but my opinion is not modified? Yes. But you have to consider the relative importance and not reduce the value of any particular matter by just putting it into, putting it at both places. If it's extremely that significant matter, then you put it in both. Otherwise, it's the judgment of the auditor, whether to put it in key audit matter or to put it under the emphasis of matter. But just because you put it in the emphasis of matter, that does not mean that now it cannot be a key audit matter, or just because it's a key audit matter, that does not mean that now it need not be a emphasis of matter paragraph. And say, in my key audit matters, I'm reporting matter 1, 2, 3. And in a key audit matter, and in my emphasis of matter, I'm reporting one key audit matter and two other emphasis of matter. So obviously this matter is a common matter. It's that important that I'm putting it in my key audit matter also, an emphasis of matter. So to convey its relative importance in the emphasis of matter and key audit matter, I will put it at number 1. To convey its relative importance. Okay, this has been such an important matter that I considered it that it should come under the key audit matter, all emphasis and emphasis of matter paragraph also. Are you understanding? Okay. What is the location of key audit matter paragraph, if any? It comes after the going concern, if any, and it comes above the management's responsibility and above that the OI. That is the placement of the key audit matter. What about the placement of emphasis of matter, other matter? What does 706 say? Where to put these paragraphs in the audit report? It says as deemed appropriate. Right? So these are floating paragraphs. They don't have any fixed location in the report. But logically, obviously, I won't put it above the title, or I won't put it after the date. So that's logically. Or no, I won't put it before my opinion. Okay, first only I write emphasis of matter. No. Right? But the standard says as deemed appropriate, you decide where you want to place these matters in your audit report, right? How you want to place these matters in your audit report. Okay, right. Now, how do I determine, okay, my God, this is a matter of the most significance in the audit. It has been the most terrific area for me to do the audit of. So one, yes, so this is the favorite package of what you need to write in your case study whenever a question is coming regarding the key audit matter. Determining matters of most significance, right? How do you determine that this has been a matter of the most significance in the audit of the financial statements of the current period? That means how do you determine and say that this has been a key audit matter? So on what basis you say that this has been the most dangerous area for the audit? When there is a higher assessed RMM or it is a significant risk. Second, auditor says significant auditor judgment has been involved in checking that matter. An auditor says I had to apply so much judgment in checking, that particular matter, 7,000 crore contingent liability. And the effect on the audit of any significant event or transaction that took place during the year. Like, generally share capital every year, we just compare it with previous year figure. Because generally every year there is no change in the share capital. But this year company came up with IPO. So obviously this year share capital checking will be so much. This year company did revaluation of their assets. So obviously as compared to every other year, this year revaluation fixed asset checking will be much more. So significant event or transaction that took place during the year. That this year Tata acquired Air India. So obviously that year the checking of that transaction will be more. Right? So determining key audit matters. And determining, so there is a significant risk, or there is significant auditor judgment, or there is a significant event or transaction. Okay, now say this year the company changed their IT system. Example, up to last year they were using Tally, and this year they migrated to SAP. Can I mention, so obviously this year will I have to do the testing of the new IT system? So every year Tally, no big change. But this year they shifted to SAP. So obviously big change. So more checking will be done. Now, is this a matter related to financial statements? See, inventory, debtor, creditor, contingent liability, related party, amalgamation, that's all related to financial statements. Now, change in IT system, is that a matter directly related to financial statements? No. But still, can it be a matter of most significance in the audit? Yes. And can it come in your audit report as a key audit matter? Yes. They asked a case study on this one. There has been a change in the IT system. Auditor had to spend considerable amount of time in doing the checking of the revised IT system. However, the management is contending that this is not a matter related to financial statements. So don't put it in your audit report under the key audit matter. No. Though it is not directly related to financial statements, still can it come in my audit report as a key audit matter? Yes, rather you see Reliance Industries. The fourth key audit matter is information technology and controls over the financial reporting. They say that has been a key audit matter in our audit, and these were the procedures we performed. Right now, yes, management had to give certain disclosures in financial statements as per the AFRF, but they forgot to give the disclosures. Auditor says, no problem, I have one new paragraph, key audit matter, I'll put it over there. Then, auditor wanted to modify his opinion. He says, modification old style, nowadays new style, you put it in key audit matter. Then, auditor had a material uncertainty, MUGC, related to going concern. Again, he says, why put in going concern? I put it in key audit matter. Or there is a separate opinion required, right? So, but again, he is not putting it in a key audit matter. Is key audit matter a substitute for this? No. Key audit matter is not a substitute for disclosures in accordance with AFRF. It is not a substitute for the modification to the opinion. It is not a substitute for a MUGC, and it is not a separate opinion on the individual matter. If I mentioned about the litigation, that means I'm not giving a separate opinion on litigation just because I mentioned about it in the key audit matter paragraph. Okay, right. But whenever I modify my opinion, qualified or adverse, will that always come in key audit matter? Whenever I issue qualified or adverse, will that always be a key audit matter? Yes. But does that mean only put it in key audit matter? No. You put it in key audit, except for the modification of opinion, these are the other key audit matters, or there are no key audit matters. Because what did I say? Whenever you issue qualified adverse, it's always a key audit. And whenever you give disclaimer, that is never a key audit matter. Yes, that is never a key audit matter. Okay, and one more point, and then I will consolidate the whole thing together. Okay, going concern. SA 570, as an auditor, you need to check for the appropriateness of the going concern assumption. Okay, what management is saying, we are having a foreseeable future. Auditor says, let me check. How much is your future? Right? The foreseeable future. So now, yes, auditor might reach to extreme conclusion. One saying that going concern assumption is inappropriate. He says, forget 1 year, 1 month also you can't survive. So going concern assumption is inappropriate. So management should prepare their accounts on liquidation basis, realization basis, and close the books of account. But they are preparing on going concern. Auditor says such financial statements will not give a true and fair view, adverse opinion, where going concern assumption is inappropriate, but management is saying it is appropriate. Okay, now situation 1, where going concern assumption is appropriate, but there is a material uncertainty related to going concern. Like, see, just go with, like, if material uncertainty, like when you come to know, oh, somebody has been admitted to the hospital, so you're like, okay, might be some health checkup or some small matter would come back. Then you come to know, oh, that person has been shifted to ICU. Then you think, oh, might be something serious. Then you come to know, oh, now doctor has put the person on ventilator. Then you come to know, oh, now doctor says next 24 hours are very critical. So now all of a sudden what happens? There is a material uncertainty, because every person who goes to the hospital, you don't think he'll die. You understand? No, you don't think. But yeah, when you come to know that somebody is put on the ventilator or the situation is very critical, then you now start having that thought, or that fear of death thought in the mind. Okay, so now there is a material uncertainty. Now for this material uncertainty, we have to check whether the adequate disclosures have been made by the management in the financial statements. So yes, management has made the adequate disclosures. They've written, okay, these are the uncertainties. We have substantial operating losses. We have the, loss of customers, all that. So has management made the adequate disclosures in financial statements? Yes. Then auditor, what you will do? Issue unmodified opinion with a MUGC. What is MUGC? The material uncertainty related to going concern para. Is related to going concern para. Right. Second one, management says no, we will not make the adequate disclosures in the financial statements. Now what auditor says? Okay, then I will issue qualified or adverse. Okay, financial statements give true and fair view except for or not true and fair. And third one, now there is a material uncertainty which auditor has come to know after doing his audit procedure. Should management also first check for going concern assumption? Obviously, presentation is responsibility of the management. So should management check for the appropriateness of going concern assumption? Yes, but management is unwilling. And a management's unwillingness, they say, no, auditor, you do whatever checking you want to do, we will not check. to do assessment of the going concern, management's unwillingness. CA says, from my side, I have done the audit, I have done the checking. I am so telling I am having a doubt regarding your going concern. You please check. They say, no, we will not check. Then what auditor will do? Consider the implications on the audit, right? Consider the implications on the audit, right? And what are the implications on the audit? Obviously, it's a limitation on scope. So it will lead to qualified or disclaimer of opinion, right? So very, very important is 4 situations over here. 1, 2, 3, and 4. Can anybody tell me what is situation 1? Yes, 1, 2, 3, 4. I've written over here. Can anybody quickly define it for me? If I say situation 1, what would that mean for you? Going concern assumption is appropriate, but the material uncertainty exists and adequate disclosures have been made by the management in the financial statements. Then auditor, what you do? Unmodified with MUGC paragraph. Situation 2, going concern assumption is appropriate, but there is a material uncertainty. Adequate disclosures have not been made by the management. Now, auditor, you will issue qualified opinion or the adverse opinion. And situation 4, going concern assumption is inappropriate. Auditor, straight away you will issue an adverse opinion. If you look into our books, right, for SA 570, there are some 17 to 18 questions given over there. Apart from a few questions which are direct question, rest all of the questions, you have simple one task in life to identify, is it situation 1, 2, or 4. Generally situation 3, there is no question, but situation 1, 2, or 4. You understand? If you see going concern is appropriate, but there is an uncertainty, management has made the disclosure easy, unmodified with MUGC. Right? Management has not, no, the fact has not been disclosed in financial statements. You say gone. It has to come under the qualified or adverse. And you say the entity is not a going concern. Then straight away you give the adverse opinion. Okay. And whenever, this is the last point of your answer, the audit report and going concern. And whenever a question regarding going concern comes in the exam, your answer has to start with as per SA 570, which is going concern. It is the responsibility, right? The objective of the auditor as per SA 570 is to obtain the sufficient appropriate audit evidence about the appropriateness. Okay, you are saying you are a going concern. Is that true? Is that appropriate? Appropriateness of the management's use of the going concern assumption in the preparation and presentation of the financial statements, and to conclude, second part of the sentence, and to conclude whether any material uncertainty and a material uncertainty exists due to events or conditions which may raise a significant doubt about the entity's ability to continue as a going concern, due to which it may not be able to realize its assets and discharge its liabilities in the normal course of the business, right? So this 10 to 12 line ka first sentence is what you always have to write in your going concern ka case study question in the exam. Any book, any author, you pick out any case study for going concern, you will find this answer over there, this sentence. As per SA 570, going concern, it is the responsibility, the objective of the auditor to obtain sufficient appropriate audit evidence about the appropriateness of the management's use of the going concern assumption in the preparation and presentation of financial statements, and to conclude whether any material uncertainty exists due to events or conditions which may raise a significant doubt about the entity's ability to continue as a going concern, as a result of which it will be unable to realize its assets and discharge its liabilities in the normal course of the business. Then you write down the going concern question are all bad news. company is not able to pay the creditors, workers have gone on a strike, production at a standstill, operating losses are there. So you say in the given case, and therefore you say adequate disclosures have been made, not been made, and accordingly you come to the report. Okay. As such, very favorite of the ICAI when it comes to the case studies in the exam. One is SA 240 and second is SA 570. So one is regarding the fraud and the other is regarding the going concern. Very, very regularly we see questions coming in the exams for this one. Rather, almost I can say every attempt. And at least one of the two you see a question coming in the exam, right? So these are the very important one for the case studies. Okay, right. So 240 we'll talk about it later. So finally, if I want to summarize my 700 card discussion so far, any matter, how it can come in my audit report, right? So one, if the matter is going to affect your audit opinion, and if it is going to affect your audit opinion, then you take it to SA 705 and you decide qualified, adverse or disclaimer. Then if there is a MUGC, material uncertainty related to going concern, then you put it in the MUGC paragraph in accordance with SA 570. Then if there is a matter which is of most significance in the audit of the financial statements of the current period, then you put it as a key audit matter. And if there is a matter which is fundamental to users' understanding or the matter is relevant to the user's understanding, accordingly you decide to put it under the emphasis of matter or the other matter paragraph, right? So do you see 7 entry points into the audit report? What are the 7 entry points? Right, one, qualified, adverse, disclaimer, right? So these are 3 entry points. What are the 3 entry points? QO, AO or DO. Then next 4, MUGC, CAM, EOM or the other matter, right? MUGC, CAM, EOM or the other matter. Okay, so maybe if I just summarize the final contents of my audit report, it starts with title, addressee, opinion, basis for opinion, or it could be modified opinion, basis for modified opinion. If it is that qualified adverse disclaimer, then MUGC, material uncertainty related to going concern, generally emphasis of matter, though they don't have a fixed location, generally. Then key audit matter, then other matter. Obviously all is if any. Other matter can come later also, but I'm telling you generally. Then if there is some inconsistent other information of SE 720, that you put it above the management's responsibility paragraph. If there is some inconsistent other information of SE 720, that you put it under the above the management's responsibility paragraph, right? So this is from SE 705, then SE 570, then SA 706, SA 701, SA 706, then other information, then after other information, same, management's responsibility, auditor's responsibility, other reporting responsibilities and signature, place and date, right? Other reporting responsibilities and signature, place and date. Right, so one of the areas where questions also come in your exams is regarding the audit report. Right, so they ask emphasis of matter, other matter, or regarding key audit matter, or which type of modified opinion, or draft or modified opinion paragraph. Right, so this is what you need to know. And specifically, you should know how does your audit report look like in case of qualified, adverse and disclaimer. What question they are asking in the exam? Okay, which type of modified opinion you will issue? So first you have to write down, okay, in this case qualified opinion needs to be issued, and then do the drafting wherein you write down the qualified opinion we have audited, then in our opinion and to the best of our information and according to the explanation given to us, except for the effect of the matters described in the very good basis for qualified opinion, the financial statements give a true and fair view. And then in the basis for qualified opinion paragraph, what you simply have to write down is only the matters which give rise to the modification. Right, one of the exam, they also asked a question on what is the location of the key audit matter paragraph. Right, so key audit matter, ideally, if it's a plain report, it comes after basis for opinion paragraph and before the management's responsibility paragraph. No, ideally, because rest all are what, if any, no. So ideally, key audit matter comes between the after basis and before management responsibility. But if there is an emphasis of matter, then first you put the emphasis of matter and then you put the key audit matter paragraph, right? So we have a humongous, a big question bank for the 700 series or whichever book you are referring to, or from wherever arrange to get the questions for the 700 series and have a look at all the questions. Right, now that you've understood the concept, and write down, you have to again write down one answer for the qualified adverse and the disclaimer. Okay, right. So what have we discussed so far? 200, then after that the 500, SQC 1, SA 220, SA 210, 700, 701, 705, and the 706, right? This is what we have. 570, yes, 570. Oh, yes, going concern. So 1, 2, 3, no, 720, I have to discuss little more. Right, so 1, 2, 3, 4, 5, 6, yes, 7, 8, 9, 10, around those, just 7, 8, 9 over there. But anyways, now what we have to discuss next is our main, a main attraction for the day is the standards in the 800 series, then the SRE, then the SAE, and then the SRS, right? So 3, 2, 3, and 2, right? So these are the standards which we did to discuss next. This is SA, no? That means it is coming under the standards on auditing only, means it is audit related only. But now what does it say? You are doing the audit of the financial statements which the management, instead of preparing as per a general purpose framework, now management has prepared the financial statements as per a special purpose framework. So what's the title of SA 800? Special consideration audit of financial statements prepared in accordance with special purpose framework. Then generally we are appointed to do the audit of the entire financial statements, balance sheet, profit and loss, cash flow, SOC notes. But now client is telling CA, do audit only of balance sheet, or CA, do audit only of the debtors, or CA, do audit only of the rent expenditure of the company. Example. So now it is special consideration audit of single financial statement, single, only one, balance sheet, profit and loss, any one. Or rather going more specific element. What could that element be? It could be an account or an item of the financial statements. That means in balance sheet also they are telling me only audit debtors, or in P&L also they are telling me only audit the rent. So now instead of saying this again and again, specific single financial statement, specific element, account or item, simply what I can call this as audit of a part, and a part of the financial statements instead of the full financial statements. And then we have the third standard over here, which is actually not this is audit of special purpose, this is audit of single financial statement, whereas this is engagements to report on summary financial statements, right? So engagement to report on the summary financial statements. Right, so that's the outline first for you for 800, 805, 810. 800 is audit, but of financial statements prepared as per SPF. 805 is also audit, but audit of part of the financial statements. And 810 is to issue a report on the summary financial statements, right? So let's take a break and then we shall continue. Okay. Right, so yes, after 1 hour, we start again.